For many investors, real estate is simply out of reach. Or is it? Fasten your seatbelts, folks. This is going to be a good one. A real estate investment trust, or REIT, is a type of investment that allows people to invest in a portfolio of income-generating real estate properties without the need to physically own or manage those assets. REITs tend to pay out a substantial portion of their earnings in the form of dividends, or they're often called distributions with REITs. That makes them a great source of passive income. Within REITs, there is an opportunity for diversification, as often a particular REIT may specialize in specific real estate types like, retail, residential, industrial, or commercial. For Canadian REITs, it is best to hold them in a registered account because there are implications if you hold them in a personal account. REITs often pay higher than average dividends because they do not pay taxes on their profits, and as a result, they pass on that tax burden to you. Because of this, their dividends or distributions are fully taxable if not protected within a registered account. One other little consideration, there can be some return of capital with some REITs, which could result in larger capital gains taxes when you sell them. Just keep them in your TFSA or RRSP and avoid all the headaches. Join the conversation. Let us know in the comments which REIT is your favorite. Your participation is well appreciated. While you're down there, don't forget to like and subscribe to stay up to date on future content, and a big thank you for that click. So, for these REITs we will be looking at today, I did filter out any REITs with a negative return on equity or a negative price to earnings ratio. I also excluded penny REITs, so any that have a share price under $1. I also excluded any REITs with a yield under 6%. Without any further ado, let's do this. We are going to kick off this list with SmartCentres REIT, which has a ticker of SRU.UN. They are based out of Vaughan, Ontario, and they are a fully integrated commercial and residential REIT with over 174 properties from coast to coast. They have a market cap of $4.78 billion and a beta of 1.19. Their earnings per share come in at 5.66, and they have a PE ratio of 4.96. Their return on equity comes in at 20.82%, and they have a debt to equity ratio of 84.19%. Their free cash flow, that comes in at $376.95 million. They have a dividend yield of 6.596%, which is paid out monthly in the amount of 15.4 cents per share. They have a payout ratio of 32.66%. Their dividends have not changed in the last 3 years, so we got a stable one here. In terms of growth, when we look at their 3-year, they dropped from $31.48 to $28.05 for a return of investment of negative 10.90%. And after factoring in the dividends, we get a total return on the 3-year of negative 4.30%. Of course, if we were doing this a couple of months from now, the 3-year will look a lot better, as this one includes that massive pandemic drop in March of 2020. In 2022, they dropped from $32.28 to $26.78 for an ROI of negative 17.04%. And once we add in the dividends, we get a total return of negative 10.44%, which, that actually outperforms the TSX, which had negative 17% on 2022. So far in 2023, they have an ROI in the positive of 4.74%. Keep in mind, most REITs are more for the dividends than the growth, so this is not bad, and we're going to see some drops here today, but we're going to see some half-decent dividends at the same time. Up next, we have Pro REIT with a ticker of PRV.UN. They are based out of Montreal, and they own a high-quality portfolio of Canadian commercial properties with a strong industrial focus. They have properties coast to coast, but the majority is in Eastern and Central Canada. They have a market cap of $380.86 million and a beta of 1.66. Their earnings per share come in at 2.35, and they have a PE ratio of 2.74. Their return on equity, it comes in at 36.69%, and they have a debt to equity ratio of 107.67%. Their free cash flow, that comes in at $39.61 million. They have a dividend yield of 6.977%, which is paid out monthly in the amount of 3.7 cents per share. They have a payout ratio of 19.15%. These dividends have been stable, though at the start of the pandemic, they did drop a little bit. In terms of growth, when we look at their 3-year, they dropped from $7.58 to $6.45 for a return of investment investment of negative 14.91%. And of course, after we factor in those dividends, we get a total return of negative 7.93%. In 2022, they dropped from $6.77 to $5.96 for an ROI of negative 11.96%. And once we add in those dividends, we get a total return of negative 4.98%. That absolutely outperforms the market. So far in 2023, they have an ROI of 8.22%. And that is absolutely even a little bit higher because I have not added in dividends yet to my 2023 data. This is another good REIT that's outperforming the market with some really good numbers, and even with a higher debt to equity ratio, they look fairly stable. REITs can sometimes have more debt as it is, well, it's part of the real estate game. Coming in our sixth spot, we have the Slate Grocery REIT with a ticker of SGR.UN. They are based out of Toronto, and they are an open-ended trust investing heavily in American grocery-anchored retail spaces. They have a market cap of $974.40 million and a beta of 1.49. Their earnings per share, they come in at 2.64, and they have a PE ratio of 6.11. Their return on equity, it comes in at 18.22%, and they have a debt to equity ratio of 127.15%. Their free cash flow, that comes in at $54.05 million. Now, they have a dividend yield of 7.172%, which is paid out monthly in the amount of 7.2 cents USD per share. So keep in mind there will be some currency conversion on this one. They have a payout ratio of 43.49%. These dividends have ranged a wee bit over the last few years, though, however, they're usually staying close to 9 cents Canadian. In terms of growth, when we look at their 3-year, they rose from $13.55 to $16.14 for a return of investment in the positive of 19.11%. And after we factor in the dividends, we get a total return of 26.28%. Holy banana bread. In 2022, they climbed from $14.44 to $15.11 for an ROI of 4.64%. And of course, once we add in the dividends, we get a total return of 11.76%. This is a number that absolutely defied the bear market. So far in 2023, they have an ROI of 6.82%, which of course is not factoring in that dividend. This is a REIT I personally hold, and with total returns like these, it is easy to see why I like this one a lot.
Great. Glad to hear it.
So at number 5, we have BTB Real Estate Investment Trust with a ticker of BTB.UN. They are based out of Montreal, and they hold retail, office, and industrial properties within Canada. They have a market cap of $649.05 million and a beta of 1.49. Their earnings per share come in at 0.77, and they have a PE ratio of 4.97. Their return on equity, that comes in at 14%, and they have a debt to equity ratio of 153.24%. Their free cash flow, well, that comes in at $72.244 million. They have a dividend yield of 7.833%, which is paid out monthly in the amount of 2.5 cents per share. They have a payout ratio of 38.96%. These dividends have been stable since a small drop in April of 2022 in terms of growth. When we look at their 3-year, they shrank from $5.47 to $3.83 for a return of investment of negative 29.98%. And after factoring in the dividends, we get a total return of negative 22.15%. In 2022, they fell from $4.06 to $3.65 for an ROI of negative 10.10%. And once we add in the dividends, we get a total return of negative 2.27%, which outperformed the TSX. So far in 2023, they have an ROI of 4.93%, which is of course not factoring in their dividend. The 3-year drop for this REIT is not pretty, but a lot of REITs really fell hard with the pandemic. They are on a very slow crawl to recovery, and if you are here looking for dividends, they have not disappointed. Coming in at number 4, we have Northwest Healthcare Properties Real Estate Investment Trust with a ticker of NWH.UN. They're based out of Toronto, and they are a big player when it comes to healthcare real estate in Canada, Germany, Brazil, and also Australia. They have a market cap of $2.42 billion and a beta of 0.84. Their earnings per share come in at 1.14, and they have a PE ratio of 8.77. Their return on equity comes in at 13.45%, and they have a debt to equity ratio of 93.62%. Their free cash flow comes in at $197.488 million. They have a dividend yield of 8.00%, which is paid out monthly in the amount of 6.7 cents per share. They have a payout ratio of 69.01%. Now, these dividends are very stable as they have not changed for more than 3 years. In terms of growth, when we look at their 3-year, they shrank from $12.70 to $10 for a return of investment of negative 21.25%. And after factoring in the dividends, we get a total return of negative 13.25%. In 2022, they fell from $13.81 to $9.50 for an ROI of negative 31.21%. And once we add in the dividends, we get a total return of negative 23.21%, which absolutely underperformed the TSX. So far in 2023, they have an ROI of 5.26%. Their drop in the bear market was big. And part of that was the fact that we had a great 2021 and a lot of recovery, which gave them more room to fall. And, well, they took that extra room for sure. Up next, we have the Melcor REIT with a ticker of MR.UN. They are based out of Edmonton, and they basically acquire, own, and manage office, retail, and industrial properties within Western Canada. They have a market cap of $171.62 million and a beta of 2.07. Their earnings per share come in at 1.06, and they have a PE ratio of 5.53. Their return on equity, that comes in at 20.36%, and they have a debt to equity ratio of 276.45%. Their free cash flow, that comes in at $10.091 million. They have a dividend yield of 8.191%, which is paid out monthly in the amount of 4 cents per share. They also have a payout ratio of 44.86%. Their dividends did drop in 2020 in response to the pandemic, but since then they have risen twice. They've not made up the full drop from 2020, but they're working on it. In terms of growth, when we look at their 3-year, they dropped from $8.25 to $5.86 for a return of investment of negative 28.97%. And after we factor in those dividends, we get a total return of negative 20.78%. In 2022, they fell from $6.73 to $5.53 for an ROI of negative 17.83%. And once we add in those dividends, we get a total return of negative 9.64%, which did outperform the TSX. So far in 2023, they have had an ROI of 5.97%. Once again, we did have some rough drops with this one, but as I've said earlier, most of these are dividend players. Bringing up our almost top spot, we have Slate Office REIT with a ticker of SOT.UN. They are based out of Toronto, and they hold a slate of 34 commercial properties throughout Canada. They have a market cap of $385.42 million and a beta of 1.14. Their earnings per share come in at 1.07, and they have a PE ratio of 4.15. Their return on equity comes in at 12.41%, and they have a debt to equity ratio of 157.97%. Their free cash flow, well, that comes in at $20.343 million. They have a dividend yield of 9.00%, which is paid out monthly in the amount of 3.3 cents per share. They have a payout ratio of 36.93%, which is pretty darn good. These dividends have not changed in the last 3 years, which is also something I like to see. In terms of growth, when we look at their 3-year, they dropped from $5.86 to $4.44 for a return of investment of negative 24.23%, and after factoring in those dividends, we get a total return of negative 15.23%. In 2022, they fell from $4.98 to $4.32 for an ROI of negative 13.25%, and once we add in some dividends, we get a total return of negative 4.25%, which really did outperform the TSX quite a bit. So far in 2023, they have an ROI of 2.78%. I do like the Slate REITs, so I have faith we will see a full recovery eventually. However, the REIT is all about passing on taxes, and growth has never really been a priority for a lot of them. In our top spot, we have the True North Commercial REIT with a ticker of TNT.UN. They are based out of Toronto, and they own and acquire commercial properties in Canada. They have properties in Alberta, British Columbia, New Brunswick, Nova Scotia, and Ontario. They have a market cap of $591.34 million and a beta of 1.33. Their earnings per share come in at 0.63, and they have a PE ratio of 9.0. 9.92. Their return on equity, that comes in at 10.56%, and they have a debt to equity ratio of 156.87%. Their free cash flow, that comes in at 85.548 million. They have a dividend yield of 9.504%, which is paid out monthly in the amount of 5 cents per share. They have a payout ratio of 94.26%, which is a little higher for some of these REITs we've been seeing today. These dividends have not changed in the last 3 years, so once again, I like that. In terms of growth, when we look at their 3-year, they dropped from $7.85 to $6.25 for a return of investment of negative 20.38%, and after factoring in the dividends, we get a total return of negative 10.88%. In 2022, they fell from $7.41 to $5.79 for an ROI of negative 21.86%, and once we add in the dividends, we get a total return of negative 12.36%, which did outperform the TSX a wee bit. So far in 2023, they have an ROI of 7.94%. With all of these REITs we have seen here today, some of these numbers do not really look the best, especially on the 3-year. As I said earlier, a lot of that is thanks to that March 2020 pandemic drop. REITs take a long time to recover from something like that. That is simply because they are structured to provide those distributions or dividends, and they do so reliably. These REITs will grow, and I look forward to revisiting them in the future to see how well they have come along on that path. Keep the learning going. Watch my video on Tesla, linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.